Things look so good. We continue to bounce. We even bounced on an intraday basis today. And in today's video, I'm going to break down what it looks like when we come off of these extreme lows and what we should expect to see now that we have established it, we have bounced. Are we done? Are we going to continue higher? What's this volatility? What could it look like? I'm going to break all that down, as well as take advantage of a stock that got beaten up in the sell-off but has quickly recovered and is giving us a bullish opportunity for a trade idea. So let's go ahead and get started today. Today is Wednesday, October 17th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for tuning in tonight. I appreciate you watching, especially welcome to those watching us for the first time. Glad you found us. Subscribe to our YouTube channel. Click that logo right here and then hit that red subscribe button that pops out. That will subscribe you to our YouTube channel. Also, click the thumbs up icon down below. That tells me two things. Number one, it tells me that you liked the video tonight. You got something out of it. Number two, it tells me that you want me to do it again tomorrow. You want me and Brandon to do these day after day after day. So that's one click, really easy way to give us feedback. You can do that right now while you're watching, or anytime while you're watching. Remember also that you comment on anything that stands out to you. We love to see what you're getting out of these videos day in and day out. Anything new, anything different that you hadn't heard before. Subscribe to our daily Market Outlook email list. There's a link popping out in the top right corner of your screen. Click that link to subscribe. Really easy way to do that. Follow me on Twitter for more content like this throughout the day, throughout the week, and join our Market Outlook community that we created on Facebook. All right, well, let's take a look at the S&P 500 first with the market forecast indicator. You see the green line has turned higher, so we have a bullish posture again, but weak bullish posture. Again, consider this indicator like a football field, and midfield is right there at the 50-yard line, and there's the end zone where the Bulls have to get the ball to, and there's the end zone. There's their backed up against their own end zone, and so it's a very weak field position if you're looking at it from a football sense, and that translates. So, but the near-term line did jump up above 80. It's a good sign, a good opportunity for the near-term line for the intermediate line to eventually cross above 50 because of that. But because it's coming from such a low level, you notice more often than not, it takes about 7 to 12 days for once the near-term line crosses above 50, 7 to 12 days before that near-term run is over and it pulls back. Well, if you look over here, for example, when the intermediate line is coming up from low levels below 50, that first near-term run that turned the intermediate line higher only lasted a few days, right? And then let's see, it lasted. You got to count it officially. It was 1, 2, 3, 4, 5, 6. 6 days you're above 50 before pullback. So we didn't quite get to 7. And then over here, when it turned up from this low level, you can see there's your first near-term run that pulled it up above 50, and it lasted 1, 2, 3 days before turning back down. So that little run right there was what it took before the next near-term rally got it up to that near-term peak. And then we ended up with a higher near-term low, and then we were consolidating there, brief intermediate pullback before turning back around. So, is this near-term line going to last 7 to 12 days? Are we going to get a cluster like this one? Probably not. The intermediate line wasn't so low here. We hadn't dropped so far from the previous. We were about the 50% Fibonacci retracement there. We dropped to almost the 100% Fibonacci retracement on this pullback. So probably going to get, a 3 to 6 day run, shorter than the typical 7 to 12 days before that near-term line pulls back. Then, where's the next low point going to be, right? Is it going to be higher? Is it going to be at 2750 or higher? Is it going to be 2700, be lower and give us a bullish divergence? Those are all things to kind of keep an eye out and watch for on the next near-term pullback. Because this one, see the previous near-term high was right here. That's way up here at the top. In our class today, I taught 2 options classes today. One was an inventory class in the morning, and then tonight we looked at trading earnings announcements using options. And so during those classes, I pointed out, on that day right there, October 3rd to October the 11th, based on the setup on October the 3rd when we closed, where volatility was and all of that, by the time we closed here on October the 11th, that was a 4 standard deviation move. That's like 99.9%. I think it's like 99.94% are the odds of a 4 standard deviation. So it actually exceeded, just by a little bit, exceeded a 4 standard deviation move from the setup, the volatility and everything, the setup we had on October the 3rd to the October 11th. That's how extreme that was. That's why it dropped so much. So it's very, very unlikely we're going to get a near-term peak on that corresponds to this run that's going to be higher than where we were on October the 3rd, or a little bit before that, October the 2nd. So getting a bullish near-term high where you get the blue line above 80 and the index is higher than the previous near-term high, a bullish near-term high is we're not going to get one. Most likely not going to get one. So when it pulls back here, where is the next near-term low going to be? Where is that near-term line going to drop below 50? Ideally not drop below 20, but most likely it can because of how high volatility is right now. But get down below, go below 50. Then where is that near-term high going to be in comparison to this one? If it's higher, then we're going to get a bullish near-term high point, and bullish near-term low, excuse me. If it's lower, then we have a good chance, potentially, because of how low this one was, of getting a bullish divergence. So either way, there's opportunity here for that next near-term low point to see what's going to happen and how that's going to impact our posture, which as of now is bullish but very weak. And so there's going to be a lot of volatility in this area. We're back up above 2,800. It's an important level, hopefully, that we hold by the end of this week. But even if it doesn't, again, when we get that near-term pullback, where is it going to be in comparison to this near-term low? You can see that all the major indexes look very similar. You can see the Dow, there's the NASDAQ, all of them, their near-term lines getting up above 80. All except the Russell are showing that bullish posture. Russell is really close. So same idea, we bounced up, we've had a good near-term bounce, most likely won't last very long, we're already a couple of days, maybe another day or two, we roll back over, then where's that next near-term low going to be? And the high, if we get a bullish near-term low, then we got a chance, a better chance, an improved chance of getting that intermediate line above 50, starting a new run, that new 1 to 3 month run. A reminder that you can watch our videos here on our blog. Remember, this link right above the video will allow you to participate in our forums for the Market Outlook. Also, you have to be a member of our site to subscribe, to participate there. You can do that for free by clicking on this icon here in the top right corner under Join Market Scholars. Remember, we look for 3 clicks to tell us you want us to keep doing these videos, the positive feedback. One is to click this heart. That will open up tonight's Market Outlook tweet. You can click on like right there. You can click on this image, this thumbs up image here. That will take you to your Facebook page for tonight's Market Outlook post there on Facebook. You can like that. And of course, you can like it here on our blog by clicking this button. Remember, you can share it with others if you feel like others would benefit from watching it through LinkedIn, through Twitter or Facebook, as well as through email. From a long-term viewpoint, you can see what the bounce looks like here. Very similar to the other bounces when you've had the big declines into the 200-day moving average. Not through it, but into it. We're getting a decent bounce so far. Obviously, we got a long ways to go to make up the losses of the last 2 weeks, but you can kind of see how this so far, the 200-day moving average is holding. We look at the 3 green arrows. We see that green arrow in the stochastics, first one. We talked about that would most likely be the first one to come about, and it is. Well, we're still not anywhere close to a green arrow on the moving average. That's not going to happen for a while. And the MACD is getting closer to forming that green arrow. You can see it's close to crossing above its moving average, but still well below 0. So we've got some. Remember that convergence, when the MACD converges to the upside, it's pretty rapid. It doesn't grind its way back to the upside. You'll get up there above 0 pretty quickly before pulling back. So that pullback that we're looking for might not occur before we come up and hit that 17, maybe even the 30-day moving average, and then we get some kind of volatility like you can see here, where we got the ups and then back down pretty sharply, and then up and then back down pretty sharply. That's a similar pattern you'd expect coming out of this. All right, the intraday chart shows where, if we do keep rallying, where the resistance is going to be. You've got the midpoint of the 4-week range right there at about 282, a little bit under 282. We're at 280.40. So expect some ups and downs in this area. There's the open for this week's Heikin-Ashi candle. We're getting above that would be, a good sign for a reversal from the upside. Even if we do pull back initially, right after that, that would give you the long upper shadow on the Heikin-Ashi. So there's some Fibonacci resistance in this areas. You can see from the pullback on the third, from the high of the third down to this low point. We've gotten up to the 38%. The rest, this 285 in that Heikin-Ashi open, that's the upper end of the Fibonacci retracement zone. So if we do break out here tomorrow or Friday, look for it to kind of peter out in this from the 50 from the 282 to the 285 area and find some resistance, and potentially then produce that near-term pullback. And that's where the next, that's going to be the next level of support. Where's the next low going to be? I would venture to guess that we'll probably, after breaking out above this, pull down closer to that 277 level, and potentially look for some support on a near-term basis in that level, then bounce off of that and then head towards the upper half of this chart and start trading in bullish territory again. If you look at the volume and the trading range today, you can see the volume is just a little bit above average. Again, that average has really shot up quite a bit. 110 million shares traded. You can see the range over about 3.6 points. If you put that into context here, 3.6 is right in this area, right about the new average. 110 million, a little bit above this new average. 3.6 is above the 1% mark. So once we get back, once those ranges fall back below 2.8 points, which is that 1% mark to the downside, then that will start bringing this back down. That's when things will steady and grind and start moving their way higher. You notice, the initial surge you can see how we lost, months worth of moves right here. But you notice in a matter of a couple of weeks, we rallied and we went up as much as it took, about 4, 5, 6 weeks to get before. So just as much as that goes down really fast and can wipe out a lot of gains over an extended period of time, when we bounce, we can get a lot of gains over a much quicker period of time than what it initially took before it eventually slows down. Same thing here. You bounce up here, and even up to this point, and that's, even during this time where we were so bullish, it takes a while, and then the volatility creeps back down below 1%, and we really start grinding in a normal bullish pattern again. So, we're in that mode right now where we're rising a lot faster now than we were in this area when ATRs were low and volumes were low. Once things settle down again, then we're going to be on the nice steady uphill climb again. Until then, ups and downs, right? High volatile ups and downs at that point. Now let's take a look at the volatility index here, and you can see volatility broke up above, got to the extreme levels, pulling back down. There's going to find some support in this area on a relative basis, this 90 to 95 zone. So don't be surprised if we don't bounce off of this. Just for some perspective, if I were to go back further, the last time in February we really broke up above to extreme levels, you see we came down, we hit that 95 level for support and bounced back up above the extreme level. Even here, we came back down, hit the bottom end of that level, and bounced back up above 1. So when you get this big spike in volatility, it won't drop all the way back down to the bullish zone just like that. It will come down to this neutral area first, hit it for resistance, and bounce and get back up above 1. That's when we'll get that near-term pullback. So kind of watch and see as it meets with some support in this area. And you can see most likely it'll probably come down and hit that 15 level for a support and potentially bounce like it did up back here, like it did here, and bounce and hit 15 and bounce and hit 15 again and bounce back up to 20. Look for it to hit 15 and maybe come down to this 90-95%, bounce and move back towards 20. And then that's where the next near-term low will be, ideally a bullish near-term low, and then we'll bounce off of that, and volatility can make that more slow and grindy move back down towards through the neutral zone into the bullish zone, and stay down there potentially for a while. So to summarize, the posture is weakly bullish again. We're bouncing off of these lows, these extreme 4 standard deviation move low points. So we're bouncing off of that. The bears are going back into hibernation. They came out a little bit. It's the fall, right? We go to Yellowstone National Park in the fall because we like to see, first of all, the colors. It's cool. There's not as many people there, and there's a lot of animals, right? It's cooler, so animals come out and you can see them. More of them. So, you know, the temperatures are cooling down. The bears came out. But, of course, it's wintertime. Eventually they're going to hibernate. And from a seasonal time of year, that's typically a good time for bulls. So we had an extreme move. A lot of bears were roaring, but it appears that eventually after they mess around a little bit, they'll go back into hibernation for the winter and we'll get that seasonal move. That's the expectation, right? Of course, anything can happen, and we'll look for anything that deviates from that expectation. But as of right now, we've had a good bounce. We're not going to get in, right back up to where those old highs were in early October. We're going to get some big moves up and subsequently back down. We'll look for that next drop, that next near-term pullback to produce a bullish near-term low point. Then that will give us our better launching to where we can move higher and grind a little bit longer and let that volatility fade away a little bit. So what do you think? Do you agree with that? Do you disagree with that? Click that poll link that's popping out in the top right corner of your screen there. Then once that will open up a poll, hit agree or disagree. If you click on disagree, scroll to the bottom of the page in that YouTube comment section below and let me know what you're seeing. That would suggest maybe you're actually more bearish, that this is maybe a bear trap that we're in, that might sucker in some bulls. Maybe you see something that we haven't shown here on the chart that you'd like to share with the rest of our viewers. Or maybe you're more bullish. Maybe you do think we're going to get back up to those old highs because you got something on your charts that would suggest that. So let us know down in that comment section below. All right, now let's talk about what's driving the price action today. Again, we're continuing to get more of a technical oversold bounce that was so extreme. It was such a big move, and those are the biggest winners. Today, however, as much as it looked like it was a bullish day, and we did close off of the lows, it still was more of a risk-off day. You can see the biggest winners today were short-term bonds, not even long-term bonds. Preferred stocks, foreign bonds, value stocks, and the dollar. And you can see gold also doing, having a relative performance versus bonds. And there's long-term bonds falling. Emerging markets, commodity prices, MLPs dropping, small cap stocks, mid cap stocks all falling down today. So it was a little bit of a move away from risk appetite. And you can see your safe haven area is still outperforming over the past couple of weeks, the dollar, gold, and agricultural. The big news today from an economic standpoint, of course, there's a lot of earnings coming out. We're right in the midst of earnings season, but you have a housing starts which maintain relatively high levels, not as high as they've been, but as high as they've been the last couple of years. And then, of course, the FOMC minutes, where they maintain that they'll continue this gradual pace. Which is interesting because after those minutes came out, you can see the rate hike odds for March, which is what we're December's baked in the cake, but for March now, that second rate hike, that's the question mark. And so there's December, right? There's a really, really good chance that we'll get that rate hike. So this is where we're at right now. There's December's move, so this would be March. So, pretty decent odds that we'll get that next rate hike. You can see March to this is the one after that. You got about a 54% chance of a rate hike of getting to 250 or higher, 54% chance, which a week ago was at 57, almost 58% chance. So it's pulled back, but it was actually a lot lower than that. We were testing 50%. We're bouncing back up on there. In fact, you can see the historical charts here for March. That 250 level, right, is that next level, that second rate hike. That's here in gray. You can see how we had pulled back down, but we're bouncing back up. And then there's the no rate hike. It's been falling, and now we have higher odds for a March hike than we do for not having one, for just having the December. Of course, not having a December or March is really, really low. And then having more than just those two is also really, really low. So we're on a steady pace, and that's what the FOMC minutes suggested. We still have, we did dip below 3.9% now, down from 4%, but still those are relatively high GDP numbers, relatively speaking. So the economy is on good footing. From a GDP standpoint, the Fed's on a gradual pace of raising high. In fact, again, there comes a point in time where you might be more concerned when the Fed does not raise rates than you are if they continue to raise rates, because continuing to raise rates suggests, especially without an inverted yield curve, suggests we have a good economy, right? Those long-term yields are rising, as you saw with TLT, making their way higher, excuse me. So let's see, let's pull up the chart here. For TLT, which had broken below an important level 115, it's made this return move and doesn't look like as of right now that we'll be able to get back up above it. If we're able to stay down below 115 and make our way towards 105 or lower, then that's long-term bonds. That means long-term yields are rising, not short-term yields, but long-term yields are rising. Very, very good sign. Just to kind of give you some context here, 2004, 2006 was our last rate hike cycle that we had. So that's way over here. The Fed stopped raising rates in June of 2006. So you can see long-term rates were rising that whole time, and eventually they hit some support in this 82 level. By the time they stopped raising rates at that 5.25%. So we have some room to go, and you see the Fed didn't raise rates. This is all QE right here, where rates were rising and the bonds were falling throughout most of 2013. Again, the economy was happy with the QE, right? And all these other times where where bonds were rising as strongly as they were not good times. This is when QE was tapering, and of course it ended, and here in the middle of 2016, bonds hit their peak. That was not necessarily the best, but since then we've been on a steady decline, and we're breaking through some support and have the opportunity to make their way down towards 100, which as we've seen in the past is actually a good sign that the economy is doing better. And as you can see in previous rate hike cycles, bond yields tend to rise as the Fed rises, and as long as those long-term yields rise at an equal or higher pace, then we can avoid that yield curve inversion that occurs when the Fed has raised rates too much, right? Too much to accommodate. So the Fed's been raising rates this whole time, and you can see these TLT is not broken below any significant level. Right, they've been raising rates. 3 out of the 4 meetings in 2017, all 4 meetings here. So during that 2017, when they were made those 3 rate hikes, they made the one at the end of 2016, one at the end of 2015. So they made that one, bonds took off. It's like, oh no, too much. So they didn't raise rates anymore until December, right? And then they raised rates in December the one time. And then they took off again, and they raised rates a few more times in 2017, and bonds were rising, yields were falling, long-term yields were falling. The short-term yields were rising, but long-term yields were falling. Now, long-term bond prices are falling, which means long-term yields are rising, and that's a good sign. So the Fed can keep raising rates as long as this continues to fall, and the breaking below 115 is a good sign for that, and gives us a good opportunity to make a run. And as we've seen in the past, when it makes that run, that's typically a very good sign for the markets. This 2013, when we had QE3 full bore and bond prices were falling to that extent, but stock prices were up like 30% that year. All right, we take a look at what's from a sector perspective: financials, healthcare, staples, and communication services were all your winners today. So that's kind of a basket, an interesting basket of who outperformed. Staples kind of in the middle here. Communication services kind of in the middle. Healthcare has been a good performer, but financials has not been. It's coming up off of this cluster. So all of these sectors, strong bearish postures, A few weak bullish postures, all below their moving averages. Healthcare is the one that's closest. Utilities back up above its moving average. So, and you can see communication services also really close to crossing above its moving average. So you can see which ones are stronger right now from a selector tool as well, and which ones continue to be weak. Energy continues to be weak. Material still trading near those lows. So those are the areas in industrials as well. Those are the areas, these three right here, that eventually we expect to take over the mantle. Initially, on this initial volatility and surge off of these lows, expect technology, expect discretionary. There's discretionary, expect technology and communication services, which benefited from Netflix today. Expect those to outperform before the rotation takes hold in these other areas that I've been mentioning before in previous videos take hold again. I mentioned before the dollar during that mid-2004 to mid-2006. Initially, the dollar started to fall on those rate hikes, and you can see rate hikes started, the dollar initially fell. Then it bounced. The dollar bounced through most of 2005. We're getting a bounce right now. And then into the end of the rate hike cycle, it fell again. So, if that's what continues, if we fall again as we continue through it could be eventually the end of this rate hike cycle, might be another year or two, then, according to previous patterns, you expect the dollar to fall at that point, and that's typical of late cycle bullish runs where commodities and yields and industrials and energy and material, all those sectors typically do better. So one stock that was actually really bullish before the sell-off, and you can see the long upper shadow, but there's that 2-day sell-off as Yum Brands. So it really got caught up in the selling. But look at the recovery. So in 2 days we sold, in 4 days you recovered, completely recovered. Very, very good sign. You have earnings coming up here pretty soon, here on October the 31st. So you have a pretty decent trend heading into that earnings announcement. The market, the intermediate line turned back up above 50 again with a strong bullish sentiment, which we haven't had for a long time this high. You take a look at like the DMI with such a strong trend that ADX has been so bullish. Look at the crossover up above 25. So the positive line has never crossed below 25. The negative line, which has been below it, made a run up above 25 with this dip, now coming back down with, again, that strong trend of the ADX. You look at the Bollinger Bands for Yum. There's the pullback into this old high point that we had, this old resistance acting as new support, getting back up above not just the moving average in the middle, but back up above the upper band. And of course, from a long-term perspective, you can see the 50 200-day moving average. On that pullback, we tested the 50, bounced right off of it, and continue higher. So not that we're looking for it to move too much higher, but as long as it stays up with this volatility, with the options where they're at, if we can get a small enough move, you can see even with the earnings, if you can get a few more dollars, you can get half of your there's about half right there, half of your maximum gain pretty quickly, but by another few dollars move up to about $95, and be able to take that credit potentially even before earnings is announced. Of course, volatility will rise, and that will have an impact. It won't rise as much for these options, the ones that are further out, these 44 days out. You can see the volatility is a little bit higher here. If I were to go back, here's a couple of weeks to 10/19/2017 on the think back, a couple of weeks before this equivalent earnings announcement here, and you can see 43 days out, 20. As we approach, watch this number right here, 19.63. As we approach earnings, it does rise a little bit. It's up to 20 now, up about a point. Let's see here. Make sure I had the right one. Yeah, so it'd be December 1st. So we'll watch that December 1st time. You can see it's at 22 as we get closer and closer. There's your earnings announcement, December 1. Whoops. Right there, got up to 23. So it rose about 4 points heading into earnings, and then drops right back eventually, right back to where it was prior, right back to that 19.97. So that volatility level could slow down the gains a little bit, of course, if the stock were to continue to bounce. Like I said, if you can get half of that gain relatively quickly, especially before earnings, depending upon how much that volatility, see, Vega is pretty low compared to your delta, so that price move will have a bigger impact than the volatility move will be. So if you get that, take it before the earnings comes out. Otherwise, position size smaller, so you got $147 max loss. You know, if you normally position size around, say, like a 1% total risk to the portfolio, then cut that in half because of the earnings announcement, because you might not get out before earnings, and just in case the stock does drop significantly, we do end up taking a bigger loss than what we normally like. We like to keep the loss to about $53 if we can. Then it doesn't take as big of a hit to us because we position size accordingly. All right, that wraps us up for today. As always, thank you very much for watching. Love to hear your thoughts. There's the link that popped out in the top right corner. Click on the forums. I want to hear what you think, what you see going on in the markets right now. What do you think about what we talked about in the video about this trade idea? Do you have any questions or comments for me? Post them there. And let me know your thoughts as well. I want to, and you can share your thoughts with the rest of the market scholars community in our Market Outlook forum on our website. Remember to subscribe to our YouTube channel. Click the thumbs up icon. Let us know you want us to keep doing these videos. Comment. Follow me on Twitter for more content like this, and join our community on MarketScholars.com. You can also, we've created a Facebook page, our Market Outlook Facebook page. You can follow us there as well. As always, have a great evening, everybody, and we'll see you all tomorrow.